All right, Quasar Markets Live. The markets are in turmoil, as they say on CNBC. And there's some ways to get around that. And welcome to the show, Dr. Alan Ellman. How are you, man?
Good to see you, Steve.
Excellent. You've been running around yourself, all kinds of shows yourself, doing the exact same thing. And here you are on Quasar Markets. And I'm going to get out of your hair. I'm going to let you do your show. And you've got something special for our members today. So I'm going to let you talk about that.
Sure, yeah. Thank you, Steve. Uh, yeah, later on towards the end of my presentation, I'm going to be offering to the entire Quasar community how to get a free month of membership to the Blue Collar Investor. This is something we're going to be doing in the very near future with our members, our new members. So I'm going to be offering it to the Quasar community today. So stay tuned for that. Today's topic, however, is related to one of my go-to strategies, which is selling cash secured puts, a similar strategy to covered call writing, but not precisely the same. So I've titled it, How to Buy a Stock at a Discount or Get Paid Not to Buy It. Those are the only two outcomes you can have when selling cash secured puts. Now, that's not to mean that there is no risk in the strategy. There is low risk in the strategy, but I'm going to show you why those are the only two outcomes. And then, as I alluded to a few seconds ago, at the very end, I'm going to tell you how to get a free month of premium membership with the Blue Collar Investor. So moving on now, let me show you what the definition of selling cash secured puts is. And I'm going to start with a hypothetical example. And then, Steve, we're going to move into a real life example with one of, I know, your favorite securities, IBIT, which is a Bitcoin exchange traded fund. But let's start with the hypothetical example where the numbers are all nice and even and rounded out to make it just kind of easier to understand. So as I said in the first bullet here, selling cash secured put is a low risk option selling strategy. We're on the sell side of options. So as I frame it in my presentations, we are the casino, not the player at the slot machines. So we are getting paid to undertake the contractual obligation to buy shares at the strike price by the expiration date. And we, the option sellers, set up the parameters of those contracts. So we decide how much we're willing to pay for those shares that can be put to us, and also how long the contract obligation will expire. So we could go with weeklies, monthlies, longer dated options. I use basically just weeklies and monthlies. Now, here's the hypothetical example. Let's say a stock is trading at 75. You really like this stock. Now, everybody likes a deal, a discount. So you say to your broker, you know what? I think I'd like to buy this stock. If it drops to 71, I'm in. 100 shares, here's $7,100. Okay? That's setting a limit order if the price of the stock reaches your target. Now, another way to do that is to sell a cash secured put. For example, on that same stock trading at 75, let's say we sell an out of the money 72 put. For puts, out of the money means lower than current market value. And let's say we get a premium of $2 per share or 200 for the entire contract. One contract equals 100 shares. This would be a fairly typical premium for a 1 month duration option contract. Now, if the price of the stock remains above 72, remember it's starting at 75. So if it never breaches below 72, well, the option buyer is not going to sell their shares to the option seller, us, for 72 if it's trading at market at a higher price. It's not happening. So what happens? The option expires worthless. We keep the $200 per contract, of course, and then the cash that we use to secure that put, I'll get to that in a second, is then freed up to secure another put for the next contract cycle. So that's what happens if the price of the stock does not go below that out of the money 72 put. Now, if BCI or the stock moves below 72 and we don't take any action to buy back that option, because we can always prevent those shares from being put to us by buying back the option. Let's say we don't do that. Well, then the shares are put to us at the break-even price point of what? What is it? Well, we bought the shares at 72, but we also received a $2 premium. So our break-even price point, or if the shares are put to what, our cost basis would be 72 minus 2, or $70 per share, which represents a discount of 6.7% from the $75 price when the trade was first initiated. Now, we use the term cash secured. So before we get into the real life example with IBIT, let me tell you what that means. Since we are undertaking the contractual obligation to buy shares at the strike price, in this case 72, our broker is going to want to make sure that we can afford to do that. So they're going to say, okay, Alan is agreeing to buy 100 shares at 72. That's $7,200 per contract. So we want him to deposit that into the brokerage cash account. But we're going to give him a little slack. We're going to let him apply the $200 put premium to that. So all he has to do is set aside $7,000 per contract. So in the case of covered call writing, we buy the shares first. In the case of selling cash secured puts, we do not buy the shares, but we set aside a certain amount of cash in case those shares are in fact put to us. And the formula is put strike minus put premium times 100 times the number of contracts. All of the spreadsheets that we created, and I'll be showing you that shortly, will do all this math for us. So you don't have to worry about the math. So now, Steve, if we can move on to the real life example with IBIT in the next slide, you can see an option chain. I took this screenshot. You can see the date on the right side of the screenshot, 10/23/2025. And this is for the November 21st, 2025 contract expiration. So it's about a month out, right? And this is for iShares Bitcoin Trust, which is an exchange traded fund based on the price of Bitcoin. Okay, so now let's look at the option chain. Remember, I told you that out of the money for puts is a price lower than current market value. Now you could see on 10/23, IBIT was trading at $62.14. So any strike price lower than $62.14 is out of the money. So the one that I highlighted in the yellow row in this screenshot is the 55. So 55, $7.14 lower than current market value. Now I highlighted for you the bid price, which is $1.04. You'll notice the ask price is $1.06. That's a very, very tight bid-ask spread, which means very favorable trade executions for us, the option sellers. And the reason for that, if you go all the way to the right of that yellow row, where it says INT, that's open interest. It shows you that there are 9,682 contracts of open interest. This is a hugely popular underlying security for options traders, right? Now, the one last thing I want to show you on this screenshot, Steve, is the delta. And you can see the delta where the red arrow is 18.69%. What that means is that there's approximately a 19% probability of that option expiring in the money. In other words, from IBIT going from 62.14 current market value to below the 55 strike, making it subject to exercise, or in other words, those shares in fact being put to us. That likelihood or probability is approximately 19%, which means there's an 81% probability that we won't have to touch this trade except for taking the cash that this option premium generated, $104 per contract. Okay, so with that being said then, Steve, how much money are we going to make? What are the percentage returns? What is the protection to the downside, break-even price point? So let's move on to the next slide now, where we actually can look at the calculations. And this, ladies and gentlemen, is the same spreadsheet that I've been showing you now for the many, many months that I've been doing these presentations on behalf of Quasar Markets. And you could see at the top of the screenshot is simply the trade entries where we enter the ticker symbol and we enter the price of 62.14. the out of the money put strike of 55, and then the premium of $1.04. Now you can also enter the numbers of shares you're obligated to purchase. I just put 100. The percentages will be the same, whether it's 100 or 10,000, the percentages will be the same. Now, in the bottom row of the screenshot are the calculations that the spreadsheet will do for us. This comes up automatically. So you could see on the bottom left that the spreadsheet tells us, okay, if taken through contract expiration, it's a 30-day trade. And that's circled in red on the lower left. Now, if you take a look at the red arrow, it gives you your break-even price point. So you could see that the price of the stock of the ETF starts at 62.14. We will not lose a penny unless the price of IBIT drops below 53.96. That's a lot of leeway in 30 days. Now, getting to the meat and potatoes of these calculations, in the brown cells, Steve, you see that the initial time value return is 1.93% based on a 30-day trade that annualizes out to 23.45%. That is our starting point. Now, take a look on the bottom right in the purple cell. It states the following, that if the price of IBIT drops from 62.14 to below the 55 strike, and we take no action to buy back that option, we will purchase IBIT at the break-even price point of 53.96, which represents a discount of 13.16%. So those are the two outcomes. So let's summarize that in the next slide, please, Steve. Okay, so look, if IBIT stays above 55, the option will expire worthless, right? The shares will not be put to us. And our profit, we will then realize a 1.93%, 23.45% annualized return. And now the cash that we had used to secure that put, that 72 minus 2 times 100, will then be freed up for the next contract cycle to then secure another put trade. Now, what if IBIT does move below 55 and we take no action to buy back that option? Well, after expiration, the shares will be put to us. You'll see this on your brokerage account when you log in the next day, Saturday morning, you log into your brokerage account, and all of a sudden, the cash that you had set aside is gone, and those shares will now appear in your account. And so those shares are put to us at the break-even price point of 53.96. Okay, so that is our cost basis for those shares. Now, at that point in time, you could sell the shares, you could write a covered call on them, you can keep them long-term if that was your goal initially. There's a lot of different things you could do with it, but those folks are the two outcomes. Generate cash flow in the form of a 23% annualized return, or buy the stock at a discount of 13%. Those are the two outcomes. Now, I'm not here to tell you that there's no risk in these trades, because if the price of IBIT does in fact drop below that break-even price point of 53.96, well, we start to lose money. And that's where our exit strategy skill set has to kick in. Next slide. So before I get into that discount coupon in the last two slides, let me just summarize about selling cash secured puts in general. This is an amazing way to generate cash flow while still retaining significant protection to the downside. Steve, I've been using cash secured puts predominantly this year because of my concerns about the overall market. And look at all the protection you can get to the downside and still generate fairly significant income. I mean, 23% annualized is nothing to sneeze at. So it's a methodology we could use to buy shares at a discount or just generate cash flow. Either way, those are the only two outcomes. But we always must have our exit strategy arsenal in place and ready to go if those opportunities do in fact occur. And sometimes you could use exit strategies not only to mitigate losses, but also to enhance gains. For example, if the price of IBIT starts going to the moon, you can actually roll up that put strike and generate even more cash flow. So it's important to understand how to manage these trades, whether it's to mitigate losses or to even enhance gains. Okay, I promised you a code to get a free month of membership, and here we go. So our BCI membership, I just showed you a brief screenshot of some of the advantages of our membership. And on the right side, Steve, are the 4 reports that we provide to our members for option trading. They can also be used for just buying and selling stock. Now, I'm not going to go into detail because you can get this on my website. There are videos and such, but we have a stock report you see on the top right. We're going to go down to the ETF report below that. That comes out midweek. Stock report comes out on weekends. Below that is our Dow 30 or blue chip report of the best performing Dow 30 stocks. And at the very bottom on the right side is our high dividend yield report for those that are into a dividend capture type strategy. Now on the left side, you could see an Ask Alan video. There were more than 250 training videos that are archived on the member site and available only to our premium members. And we add 2 new videos every month. So that's available only to premium members. You could see at the very bottom, it says continuing education. We have over 20 different 2-hour webinars available only to our premium members. And of course, anything else in our store is discounted to our premium members. So let's go to the next slide, Steve, and I'll show everybody how to use that join free discount coupon code. Just go to our website, thebluecollarinvestor.com. Click on the membership link circled in that red oval on the top, and then scroll down, all the way down. I'm just showing you the top and the bottom of this page, and click on the link that says sign up for the 1-month membership. And you just put in the coupon code join free, and that is free. Now, you can continue that automatically at $69 a month, or you can opt out at any time. So if you opt out before the end of the first month, then you will just have had an opportunity to look at our site and you will have paid nothing. So once again, the coupon code is join free. It will be up for a limited time, but available to Quasar Market members as of today. So Steve, I think that pretty much does it for today. Selling cash secured puts, it's an amazing strategy when implemented properly. And I'm happy to share with members of the Quasar community how you could use it both to generate cash flow, to get huge protection to the downside, and or buy a stock at a discount.
Yeah, I mean, it's great because especially in days like today and the last few weeks as the market's been pulling back, people will be like, what do I do? And I think that, selling those cash puts is the key, right? I mean, you got to learn options. And it's very simple. For those of you out there, go to thebluecollarinvestor.com, thebluecollarinvestor.com, and go to that section he told you about. Go to membership, and then go to the bottom, sign up. And the code is join free. So sign up that, make sure you get that done. And I'll see you right here next week, Alan, same time, same back on Wednesdays, all right?
Thanks, Steve. Good to see you. Take care.
Too.
Bye.